Something happened in the silver market last week that most people completely missed, and the few who did notice it went very quiet, very fast. Not because it was confusing, but because the last time this exact same signal appeared, it set off one of the most explosive price moves in the history of precious metals. We're talking about a pattern so rare that most analysts alive today have never personally witnessed it trigger twice. And right now, in real time, it is triggering again. If you've been paying any attention to silver over the last few months, you already know prices have been climbing. But $92 per ounce is not just a number, it's a threshold. It's a signal. And the people who understand what it means are making very serious decisions about their money right now. By the time you finish this video, you are going to understand exactly what this signal is and why it matters. You'll also learn why most mainstream financial media is ignoring it and what it might mean for ordinary Americans who have never once thought about silver in their lives. So before you scroll past this video, before you go back to whatever you were doing, ask yourself one thing. If someone told you that a rare financial signal with a near-perfect historical track record just fired, would you want to know about it? Of course you would. That's why you're still here. And that's why this video exists. Stay with me, because what I'm about to share with you is going to change how you see the next 12 months of your financial life. And by the way, if this kind of content is something you find valuable, take 3 seconds right now to hit that like button and subscribe to this channel. It costs you nothing, it helps us reach more people who need this information, and it makes sure you never miss a video like this one again. We cover things here that the mainstream financial channels simply won't touch. Now let's get into it. Let's start with the basics, because the foundation matters. Silver has been used as money for over 6,000 years. It predates the Roman Empire, predates paper currency, predates every financial institution you have ever heard of. For most of human history, silver and gold were not investments. They were money itself. The idea of silver as an investment is actually a relatively modern concept because for centuries it just was the standard. And that history matters because what's happening right now in the silver market is deeply connected to something far more fundamental. What's happening right now is connected to the global loss of confidence in paper money. This is not a small thing. This is a shift that takes decades to build and then moves very fast once it breaks. Now here's where it gets interesting. Over the last 3 years, something has been quietly building in the silver market. Most retail investors and even most professional fund managers have not been watching closely enough. There's a metric called the gold to silver ratio. It is one of the oldest and most reliable indicators in all of commodities trading. It tells you how many ounces of silver it takes to buy 1 ounce of gold. Historically, the long-run average sits somewhere around 50 to 1. In ancient Rome, it was 12 to 1. For centuries before central banking became dominant, it hovered between 15 and 20 to 1. Today, even after silver's recent run-up, that ratio is still historically extreme. And every single time in modern history that the ratio has reached these distorted levels and then begun correcting, silver has massively outperformed gold. We are in that correction right now. Silver at $92 is not the end of the story. If the ratio reverts toward its historical mean, we could be looking at prices that would seem absolutely unreal from where we sit today. But the gold to silver ratio is only part of the picture. Let's talk about the signal that is really getting serious attention in institutional circles right now. It's called a technical breakout confirmation combined with a physical supply squeeze. The combination, that specific 1-2 punch happening simultaneously, is extraordinarily rare. Here's what it means in plain language. A technical breakout happens when a price smashes through a major resistance level that is held for years and then closes above it repeatedly over a period of weeks. That tells technical analysts that the old ceiling has become the new floor. The psychology of the market has fundamentally shifted. Buyers are in control and they're willing to pay more, full stop. Now combine that with a physical supply squeeze, and this is where it gets genuinely alarming. Silver is unique among precious metals because it is consumed in industrial processes. Gold, you melt it down and make it into something else, and you still have the gold. Silver is actually used up. It goes into solar panels, electric vehicle batteries, semiconductors, medical equipment, and defense applications. And because of the global green energy build-out, industrial silver demand has been outpacing mine supply for 3 consecutive years now. The LBMA vaults in London and the COMEX inventories in New York have both been showing declining registered silver stocks. And when registered physical stocks fall while paper contracts stay elevated, something has to give. Usually it's the price, this is the squeeze. Physical silver is being pulled out of institutional vaults and delivered to industrial users at a rate that is quietly alarming the people who watch these numbers for a living. And now the technical picture is confirming what the fundamentals have been screaming. That is the rare signal, both things happening at the same time. Now let's talk about what really happened the last time this combination appeared, because history is the best teacher we have. Go back to 2010 and 2011, silver was sitting around $18 to $20 per ounce coming out of the 2008 financial crisis. The Fed had slashed interest rates to near zero and launched the first round of quantitative easing, which is a fancy way of saying they printed trillions of dollars and pumped it into the financial system. Physical silver demand was rising, vaults were tightening, and the technical picture showed a clean breakout above resistance that had held for decades. What happened next was one of the most violent price moves commodities markets had ever seen. In roughly 8 months, silver went from $20 all the way to nearly $50 per ounce. That's a move of almost 150% in less than a year. People who understood the signal made life-changing money. People who ignored it watched from the sidelines. Now I want to be very clear about something, because I respect you too much to just feed you hype without the full picture. Markets are never certain. Silver has been volatile. It has made big moves up and then given back significant portions of those gains. Anyone who tells you silver is a risk-free investment is lying to you. Commodities markets can be influenced by things that are hard to predict. Central bank policy changes, sudden surges in mining output, shifts in industrial demand. These are real risks, and they deserve to be taken seriously. What I am telling you is that the signal picture right now is historically compelling. It does not guarantee any specific outcome. It suggests, based on historical precedent, that something significant may be building. What makes this moment different from 2011 in a way that could actually make it more powerful is the macro backdrop. In 2011, inflation was elevated, but it wasn't completely embedded in the consumer psyche the way it is now. Today, millions of ordinary Americans have spent the last several years watching their grocery bills climb, their rent climb, their insurance premiums climb, and all of this while their savings accounts earned effectively nothing in real terms after inflation. The erosion of purchasing power is no longer an abstract concept for most working families. It is a lived experience. And when ordinary people start reaching the conclusion that paper money is losing value faster than they can earn it, historically, they reach for silver and gold. Not because of charts, not because of technical breakouts, because of instinct. Because of 6,000 years of human memory baked into our collective financial psychology. And here is the uncomfortable truth that most financial television will never tell you. The dollar has lost more than 97% of its purchasing power since the Federal Reserve was created in 1913. $1 in 1913 would need to be roughly $35 today to buy the same basket of goods. Every paper currency in history that has been inflated without restraint has eventually found its level. Silver and gold have not lost their purchasing power over the same period. An ounce of silver in ancient Rome could buy a Roman soldier's daily wages. An ounce of silver today still buys a comparable amount of real goods. That's not a coincidence. That's what real money does over real time. Now here's something that I think is genuinely underappreciated about this specific moment. We are not just dealing with American monetary dynamics. We are watching a global shift in how sovereign nations think about currency reserves. The BRICS countries, Brazil, Russia, India, China, South Africa, and now several additional nations who have joined or are seeking membership, have been actively discussing the creation of a new trade settlement currency that would be backed, at least partially, by commodities including gold and silver. This is not a conspiracy theory. This is publicly discussed at international summits. Multiple credible financial publications, including the Financial Times and the Wall Street Journal, have covered it. The shift away from dollar dominance in global trade, if it continues to accelerate, creates a structural tailwind for silver that goes far beyond short-term trading charts. It is a multi-year, possibly multi-decade, fundamental realignment. Now imagine you're a central bank in a developing country and you're watching the dollar-based financial system weaponized through sanctions the way it was with Russia in 2022. What lesson do you take from that? You diversify. You hold more physical gold and silver. You reduce your vulnerability to a single dominant currency. That is exactly what data from the World Gold Council and various IMF reports shows has been happening. Central bank gold and silver purchases have been at multi-decade highs for the last 2 years. The big money, the nation-state level money, is moving. And retail investors in America are largely still asleep to what that means. Here's the question I want you to sit with for a moment. And I genuinely want you to think about this, not just nod and move on. If everything I've described, the technical signal, the physical supply squeeze, the macro backdrop, the global monetary shift, if all of that is accurate, what does that mean for the ordinary American? What does it mean for the person who has 90% of their wealth in dollar-denominated assets? What does it mean for your 401k, your savings account, your mortgage-heavy real estate? Now, I'm not telling you to do anything specific with your money. I'm not a licensed financial advisor, and you should absolutely speak with one before making any significant financial decisions. What I am telling you is that the conversation is worth having. The question is worth asking. Because the time to think about protecting your purchasing power is before a major move happens, not after. Before we wrap up, I want to pull everything together because I think there's a narrative running through all of this that is easy to miss when you're looking at individual pieces. The $92 silver signal is not just a commodity story. It's a monetary story. It's a story about what happens to financial systems that expand their money supply beyond what their real economies can support. It is a story that has played out before, in Weimar Germany, in 1970s America, in Argentina, in Turkey. The details are always different. The outcome has a disturbing consistency. And silver, quiet, humble, industrial, unglamorous silver, has functioned as one of the most reliable early warning systems that this process is underway. The people who are paying attention right now are not doomsday preppers in bunkers. They're institutional fund managers, sovereign wealth funds, family offices that manage generational wealth, and a growing number of ordinary Americans who have simply done the math and decided they'd rather own something real than hold something that can be printed in unlimited quantities. That is the signal behind the signal, and you heard it here. I would genuinely love to know what you think about all of this, because this is the kind of topic where your perspective matters. Have you already been holding silver? Are you thinking about it for the first time? Do you think I've got this completely wrong and the dollar is just fine? Drop your thoughts in the comments below. Seriously, every single comment gets read on this channel, and your real-world experience with inflation, with investing, with protecting your family's financial future adds enormous value to this community. Don't keep it to yourself. And if you know someone, a friend, a family member, a coworker, who needs to hear this information, do them a favor and share this video. It takes 3 seconds, and it might be one of the most useful things you do for someone you care about today. Thank you for watching all the way through. I know your time is valuable, and I don't take it for granted. This channel exists because of people exactly like you, who take these topics seriously. Keep asking hard questions about your money. Keep thinking critically about everything you hear, including everything you hear from me. And we'll see you in the next one. Sonnet 4.6 Extended Claude is AI and can make mistakes.